Hey, good morning, everyone. Welcome back from a 3-day weekend. Hopefully, you had a nice, restful weekend. I know I did. Watched some college football. That was fun. There were some good games that were played. And now it's time to focus on stocks and see where the market is headed. I'd like to take a look at the stock market, see what's going on, see if we're going to open lower or if we're going to see those negative values go upward. We'll take a look. And I also wanted to look at the economic calendar. I think there's one key day this week that we're going to look at. And really, the most of the call is going to be around stocks, some individual stocks. I've got a list of stocks that people have suggested on um, the comments on videos that I put out there of stocks that people are interested in. Also, take a look at the stock that's going to be on the stocks raffle and take a look at that company and see what I think about that company. Viewer requests are encouraged. If there's a stock out there you're thinking of, you want to bring it into the live stream, please put it in the comments. I'll take a look at that stock. If I could provide comments, I will, and we'll go through it, see if we can do a quick valuation on it or not. Sometimes some of these stocks are really difficult to review on the fly, but if I can, I will. So let's get into it. So first off, looks like the market is going to open lower. The Dow, S&P, and NASDAQ are down considerably, half a point. So that's pretty good. Crude oil is down 2%. So the oil complex is probably going to be discounted today. And we'll take a look at that. I know that I'm going to look at a couple of energy stocks on the symbols that were suggested by viewers. We'll take a look at the energy complex. One thing, my portfolio did well in the month of August, but I was kind of held back by my crypto portfolio. Crypto in the month of August didn't do so well. And I measure appreciation and I had depreciation in the month of August for my cryptocurrency coins. Overall, happy with the BTC performance over the last couple of years, happy with Ethereum. But the month of August was a negative month for my crypto. And it's good to see that on the crypto universe, we've got Bitcoin up 2.2%, Ethereum's up almost 4%. Go Ethereum. So we'll see how crypto does. That's interesting. The market is down and then cryptos are up. All right. So the biggest news this Friday that we're going to get that could move the market is going to be the Friday's payroll report. It's expected that the unemployment rate is going to come in at 4.2%. And that's good unemployment, meaning it's not high unemployment, which would be recessionary. So we'll see where we land. If unemployment were to go substantially higher, let's say it came in at 4.5%, there probably would be a pretty bad sell-off on Friday. If the unemployment report came in considerably lower, let's say it came in at 4%, then we would have a pretty strong rally because the market would expect that the Federal Reserve is going to lower interest rates by a full 50 basis points. And that would be quite good for especially small caps and growth stocks. So that's going to be the big news on Friday before the market opens. I'll be streaming live each trading day this week, so we can take a look at that report together on Friday. But that's the big news economically that we would expect. Let me say hello to some people who are already on the chat. Noam, good morning, sir. Shadow Guy, good morning, sir. Thank you for joining this morning. And I know, Shadow Guy, you're in Europe, so I guess it's good afternoon, sir. So thanks for joining. Let's get into it. So today we got earnings from a couple of companies. Zscaler, looks like the security stocks are really getting a lot of attention with our friends at CrowdStrike being vulnerable. So Palo Alto earnings, I think, had a little extra interest. And I think Zscaler is going to get some interest. Every time I've seen or I've looked at Zscaler, it's looked somewhat interesting. Let's take a look at that one a little later. Put that one toward the end in case there's any suggestions. And GitLab is going to report after the close. That's going to be part of the stocks contest today. So if you guess the stock price 30 minutes after the market closes and you nail it, you you get a lion's share of the prize of $1,000 raffle, I believe. So I know I'm going to wait probably till about an hour before the market's going to close, and then I'll put in my best estimate on GitLab, and we'll go from there. I'll take a look at GitLab just to kind of get acquainted with the company and provide a few comments on it. The other companies I'm not really familiar with. I've never really heard of them. So I would say that, this one, this pharmaceutical company, that might be interesting to take a look at, but I think I've got plenty of stocks to work with, and I'll get going. All right. So this company, NextEra Energy, this is a company that was provided in comments on one of the above: Discord, one of my videos on YouTube. They provided comments, and what I decided to do is just kind of bring all the comments into the live streams, and then I'll cover the stocks, and hopefully whomever provided the comments gets to see this section so that they see my thoughts on it, because they were asking about it. So NextEra Energy acquires and owns, manages contracted clean energy projects in the US. So it does wind, solar, battery storage. Okay. And some areas of the electricity production space or complex they've done really well. And I think the whole data center build out has really excited, investors. So they really, have created a big rise in those stocks. This one here, not so much. In the 1 year, it's down 50%. Wow, that's a big drop. I took a glance at this, and I'm not quite sure why it dropped so much, because when I look at their earnings and their revenue, it looks pretty good. We've got positive growth in 2022, positive growth in 2023. When we look at the quarterly, we've got positive growth, green on the screen. So I'm like thinking to myself, what am I not seeing? Is there something that's really bad? So I'm going to take a closer look and kind of drill into it a bit and see what's going on with this company. So the revenue of the company looks good. It's profitable. Balance sheet, cash is $281 million. And debt is 5.7 billion. So 5.7. Okay. So how much is EBITDA, right? So it's going to be net about 5.5 billion of net debt. EBITDA is 633. Yeah. So debt is a little bit high. So if you look at debt to EBITDA for this company, is going to be about, I would say about 7.5. And that is pretty high. I want it to be under 3. So the balance sheet is a problem with this company, that they have a lot of debt. So I don't know if that's worrying investors, is that's what's causing, investors to really be bearish, pessimistic on the stock. The cash flow, I think, looked pretty good. I glanced at it. And is this the annual? Yep, annual. So free cash flow is 149. So it's not very good. You see, it was negative in 22 and 23, and then it's positive in the trailing 12 months, 149. So NextEra is not going to, I can't value based on cash flow up to 2.34 billion. The best I could do is probably like 1.4 billion. And the balance sheet's bad, where there's too much debt. So having said that, I'm going to have to pass on NextEra Energy. The balance sheet doesn't look good, and the free cash flows don't look good. Maybe the investors are beginning to realize that and have sold off the stock. It hasn't done very well in the last 12 months. So there's another energy company that came up again in comments and so forth. That's BEPC. So Brookfield Renewable Corporation. And this company, Brookfield Renewable Corporation, owns and operates a portfolio of renewable power and sustainable solution assets, primarily in the United States, Europe, Colombia, and Brazil. It operates hydro, wind, solar, and distributed energy. Okay, cool. Okay. Well, that looks interesting. Um, it's a $10 billion company, and looks like their P ratio is going to be 14. Nice dividend if you're an income investor and need a nice dividend. These utilities tend to pay a nice dividend. That's why a lot of investors like it. And analysts think it's a buy, and it's discounted by 17%. All right. So when we look at their growth, nice revenue growth. Been growing for 3 years, and the trailing 12 months at 21%. Very good. Maybe the COVID year, people weren't using as much power because we were stuck at home. So maybe that's why they had a negative month. They have been trailing 12 months, they're profitable. Did have a loss in 2023. All right. And then free cash flow, negative in the trailing 12 months, but it was positive in 23, positive in 22. It was negative in 21. And I'm going to look at the free cash flow a little closer. Then we'll look at the balance sheet. So one of the negatives for me on utilities is they have to put too much capital back into their businesses. It's like you're rebuying the business every 3 years with the cash. And to me, that's not a good industry. It's not a desirable type of company. I like companies that produce a lot of free cash and they don't have to put much back into their business. They get to take that cash, buy back shares, pay dividends, keep a big cash pile on the balance sheet, acquire other businesses. Just a lot of good things can happen when a company can really accumulate free cash flows. And utilities, they don't do that. They have to keep reconditioning their plants, reconditioning their infrastructure. Just it's very expensive operation. That's one of my undesirable industries is utilities. So I really don't invest in them. Let's take a look at the cash flow statement and see if this utility is different. So operating cash flow, this is what they do, or the cash that is derived out of operating the business. So that looks pretty good. But see, this is where my interest kind of goes down, as the capital expense in the trailing 12 months is really high. So you generated all this cash and you got to put it back in the form of parts to recondition, the energy production capacity, all kinds of stuff that has to go back into the business. So, I've arrived at the same, kind of outcome that I always do with utilities is I'm going to pass. This, like, we have thousands of companies, thousands of stocks to pick from. We could buy Meta. We could buy a utility company. We can buy consumer discretionary. There's so many choices. Why pick a choice where the company is going to have to put so much capital back into their business just to continue to operate? To me, it's just not a good business. So for this investor, I'm going to pass. So that's my comment on BEPC. All right. So let me double check on comments. Give me 1 second, please, so I get my bearings straight. And looks like no new comments, but let me just remind everybody, if there's a stock that you're interested in seeing, please put it in the comments. I'll take a peek there every 5, 10, 15 minutes. And if you put a stock symbol, DG, look at that. Got a customer already. DG, not familiar with it, but let's take a look. All right, so DG is, okay, Dollar General. We looked at Dollar General last week. It was not a pretty story, right? Whew, man. So coincidentally, the retail is tough. It's a space that I'm very careful in. Again, we have thousands of companies that we get to choose from. Like we get to pick from technology stocks, healthcare, pharmaceutical, biotech stocks. We get to pick all kinds of these really interesting companies. And retail companies, they kind of lure us in because they have usually really low stock prices. And we're like, oh man, maybe it's going to bounce back. But a company like Dollar General, they're here for me. And what does that mean? So I created this quadrant of desirability. The most desirable companies are like Meta, Google, Microsoft. They're growing. They're in industries that are expanding, very profitable. Margins are massive, huge free cash flow, all kinds of good stuff going on with that company. On the opposite end is they're in an industry with too much competition. There's competition at every corner. Margins are super thin, no cash flow. They're in a contracting industry. It's just getting harder and harder over time. That's Dollar General. Their competitor, 99 Cent Store, went bankrupt recently. That just shows that, hey, it's a tough industry. It's tough just to be a retailer, but to be a discount retailer where you're like really squeezed for margins, and you've got Amazon selling online, you got Temu that sells all this affordable, cheap stuff. It's just really hard to operate a business like that. So they're really in the undesirable zone for me. And, I'd rather stay away from a company like Dollar General. Now, I looked at this last week, so I kind of have an understanding of it. And the PE is low. Yep, got it. Analysts say, hey, there's a buy recommendation, and it's discounted by 36%. I think those opinions probably are pre their announcement of earnings. It's one thing to look for a bargain stock, and everybody gets to invest the way they want. I pick my lane, which is I want high quality. High quality is going to double in value every 5 years, if not sooner for me. Quality is probably going to sustain recessions and pullbacks far better. And I'm going to have fewer surprises. Now, I take risk from time to time. If you saw my portfolio, there'd be a couple stocks where it's like, ooh, that's high risk. And that's calculated, but it's seldom ever in retail. Retail, I've learned, and I've lost money, and I've paid for lessons that I've learned in retail. And I don't like paying for lessons. You can watch a stock. You don't have to pay for lessons. If you watch it and then, oh, that's what happened. Okay, cool. But if we look at their financials, let's take a look at growth. Growth is okay. Let's look at the quarterly. Growth is okay. Company's growing. Now, gross profit on a number of 10 billion, their gross profit's 3 billion. So gross profit's 30%. Then after they're selling and so forth, their operating income is 549 million, which is going to be about 5% operating income on that revenue. Net income is 374. Net income is contracting. It's been coming down. So I think investors were probably seeing that and having a little trouble with it. If we look at the debt, total debt is 18.2 billion, and they have 1 billion in cash, so call it 17 billion. We want that to be less than 3 times EBITDA. EBITDA is 3 billion. So if they're at 17 and you have 3 billion in EBITDA, what that means is it's going to take more than 5 years for you to pay back that debt, closer to 6. So closer to 6 years to pay off your debt if you devoted your EBITDA to paying off debt. The problem is, again, if you look at their financials and you look at their profitability, it is continuing to go down. Net income is going down. So EBITDA continues to go down. So it may be 7, 8, 9 years to pay off debt. And in that zone, that means it's going to be very hard to ever pay off the debt. It's just too high of a debt balance. So high risky balance sheet, and cash flow wise, they have a good free cash flow. If you look at their free cash flow, 1.7 billion. No, they're even with their cash flow, I would at best be able to multiply that number by like 6 or 7 or 8 if I was feeling generous. That would get me like 12 billion. So I would not touch Dollar General. I wouldn't follow it. I just wouldn't do much with it. I think this one is just, it's going to bump along the bottom, and maybe some investors are looking for a nice, 20, 30% pop. If that's your lane, good luck. I hope it works out. I hope you make lots of money. That's not my lane. I'd like to know, in some cases, I might have a little fun. Like I bought Dell before the earnings, it popped, I sold it, I made a few bucks. Okay, that was controlled. And if my lane is buy a stock that you think is going to appreciate, probably the recipe for success that I use the most is I think it's going to double in the next 5 years. That's like the primary recipe. In some cases, some industries don't set themselves up for that because they're cyclical. I might say, hey, this is going to do well over the next 2 years. Okay. That's cool because I'm still long-term minded. And Dollar General just doesn't fit into my toolbox. My tools are made for, you got to start with quality. You got to start with something that's desirable. But thanks for asking. It certainly caught a lot of attention because it fell off a cliff. It looks like somebody wants to see TLRY. Thanks for joining, guys. So TLRY. Tilray Brands is a lifestyle consumer products company, engages in the research, cultivation, processing, and distribution of medical cannabis products in Canada, United States, Europe, Australia, New Zealand, Latin America, and internationally. So cannabis, when it was first legalized in the US, cannabis stocks are really priced high. And I think they've disappointed investors. They haven't really done great. This is a really low price stock, 1.7, $1.71. See, this is what I mean. So cannabis stocks are supposed to be quite lucrative, and they haven't been. This company has revenue of 788, but they lose $244 million. Holy smokes. They are growing their business, but they're doing it unprofitably. Now, I don't know this industry inside and out, but I have a sense of it, right? They've been losing money. Okay. Free cash flow. There is no free cash flow. So this one here is like, I can't put a value to it. Negative free cash flows, negative earnings per share. I can't calculate when I have zeros. It makes the math go to zero. So this is the type of stock where if you felt like, hey, Tilray has the right business and this stock's so priced so low that it's probably going to rise for other factors that you're considering, I can understand somebody doing that, but that's not the lane that I'm an investor in. Back to the whole quality story. I won't bore you with that again. But this isn't a stock that I'd be interested in. I'm going to have to pass on TLRY. There's just nothing there for me to value. If you recall from, maybe you've seen another one of my videos, I calculate net present value of free cash flows. Like here, Amazon produces a lot of free cash. And then I get to a net present value so that I could say per share, how much is that cash flow worth? And then I compare it to the stock price and say, hey, Amazon's discounted by 22%. And then I look at earnings per share and do something similar. I do an intrinsic value formula and get to what I think is intrinsic value of a stock. And then I compare it to the current stock price. It's discounted. I blend the two and I put more weight in free cash flow and say, hey, Amazon's being discounted by 18%. So I'm a buyer of Amazon. That's how I do evaluation. And I can't do that if you give me zeros. If I put those formulas, it gets to zero. And it's like, hey, this stock's worth zero. Okay. Can't do it. So I have to pass. Thanks for asking. And hello, Zaki Prince from Nigeria. Thanks for joining. So is it Buse Stratter, Booze Trader, I guess. Sorry if I got it wrong, man. It's early for me. Let me drink some more coffee. Thanks for the analysis on DG. What was the ratio of debt, EBITDA you prefer? 3 debt to EBITDA. So let's take a look at a quality company. Let's go with the Meta, right? These guys are like really valuable. When we look at their balance sheet, well, that's a bad example because I'm going to show you in a second. They have $32 billion of cash sitting in a pile, and then they got another pile of short-term investments. So they have $58 billion of cash. It's like, holy smokes, man. You're going to need like a really big safe to put all that cash in. And then their debt is $38 billion. So these guys are net zero debt. So that's why it was a bad example. But what you would want is let's say you had $10 billion of debt and your EBITDA was $5 billion. You'd provide EBITDA of $5 billion. You would be at a 2. 10 divided by 5 is 2. You're at a 2. I think I picked the wrong one here. Meta being a bad example because they don't have any net debt. So that was it, buddy. Yeah. So A Owens 14. Yeah. Glad to provide an opinion. My investing, the thing about investing is there's 1,000 ways to invest. You have day traders that trade and they're successful. They see information, data, and they trade and they're successful. Then you have long-term investors that are like, look, I'm going to buy these 5 stocks and I'm going to hold them for a long time. Okay. And then there's everything in between. I'm an investor. I'm a long-term minded investor, but I'm active. Okay. I'm not hey, I'm going to buy it and pretend I know the future and hold it forever. Now, could I see myself holding Meta for a long time? Absolutely. At this point, why wouldn't I? It looks great. But what if like a lot of bad things happened in 2 years? I'm going to reassess. What if a new competitor comes out and really starts taking away market share? Okay, I'm going to reassess. So I'm an active investor, long-term minded, but I really measure performance monthly, quarterly, annually. And what I want to do is, every stock that I have has to have the likelihood of doubling every 5 years or better. And that's my mindset. So thanks for asking. All right. So Solar Edge was a request on a comment. And these guys, the solar stocks have been challenged. The stock market's open. One quick news alert. Where's the stock? Ooh, market's trading lower. Come on, stock market. We had a nice weekend, 3 days off, nice and rested, drinking a good cup of coffee. It'd be nice for a rising stock market on a Tuesday. We'll see if I get my wish. All right. So Solar Edge Technologies, they do a lot of the equipment gear. I have solar panels installed in our home. And guess what kind of technology they use? They use Solar Edge. I have the Solar Edge app on my iPhone. So I get to see the production of my solar panels. It's pretty cool. It's pretty cool to have solar panels. And it saved me money on my energy cost. And I'm in California. But they've changed the laws. They used to be specific to California. I think each state's different. And each utility, and the states, I believe, are the ones that regulate the utilities. The utility in California made it really desirable to get solar panels. So I'm actually saving $150 a month with my solar panels based on prior consumption of electricity and how much it cost us compared to now. We're saving $150 a month if I include the whole cost of the solar panels, everything. And I'm like, that's like the no-brainer. I'm saving like $1,800 a year for like 25 years. Sign me up. So boom, put them on there. They changed the rules, and now somebody that buys solar panels today they're not getting anywhere near the situation that I'm in. I think you would really need somebody would want solar power, and they would want to install it because you're actually going to pay more for power using solar panels, it's going to be discouraging. Now, the one game changer is all new construction in California has to have solar panels. So if you build a new house, it has to have solar panels. If you build a new multi-tenant building, has to have some type of renewable energy. Solar being, the favorite. I don't think people are going to put windmills and stuff on buildings. So that's one of the headwinds is the legislation's changed. And what was once really promoted by the government is beginning to lose some of that push. So let's take a look at their financials. The stock over the last 5 years. Oh boy. Ooh, no bueno. Let me speak some Spanish to you. That means no good. And Solar Edge Technologies. I like looking at Google because it allows me to look at like a peak and say, oh, look, the market said Solar Edge, you're so terrible. We're going to sell you off. And we think you're only worth 7 cents on the dollar compared to the high price that you established back in 2022. Now, I know that I think they make good products. I've been using their products. I think their product's pretty good. But you could see this revenue just collapse. Ooh, man, that's bad. You can see the high point here. People are putting money into their houses. Maybe a pullback due to COVID. So this looked really good. High growth, high growth, high growth. And then they stopped growing, and now they're hitting a wall. We look at the quarterly to get more specific. Wow, man, this is bad. This is Q2. There's also some seasonality, right? You're not going to be installing a lot of solar panels in the dead of winter because it might be snowing, raining, conditions are bad. But Q2 shouldn't be all that affected by winter. So that's interesting that their revenue is just collapsing. Wow. So revenue's collapsing. They're losing money. and their free cash flow is, they don't have free cash flow. They burn cash. Okay. That is not good. So I'm not liking their situation. I just explained kind of like some of these big forces around their industry that changed, right? Let's look at their balance sheet just to look at it. 689 billion in free cash, cash and short-term investments on the balance sheet. And then we have total debt of 729. See, they have almost as much cash as they do debt. So debt is under control. And I already went over cash, so they don't produce any free cash. So the one thing, this would not have much value using my techniques. So I couldn't voice an opinion. Hey, is it worth $1 billion, 5 billion? My models would be, this is worth zero. It doesn't produce free cash flow. It loses money. So this would be another situation where if you know, in fact, that, hey, legislation is going to change for the better, there's going to be better rules for solar companies, maybe there's a play there. Okay. But what I'm seeing is, these guys are having a tough time. The good news is their balance sheet's pretty solid. They got plenty of cash and they got very little debt. So they got a solid 3 years to figure this thing out. How are they going to grow? How are units of solar going to keep growing? Now, the consumption of power keeps going up. Data centers are not making it easier. They're making it harder. More capacity has to be put online for companies to produce electricity. Having said that, I'm going to pass on SolarEdge, and there's the other solar stocks, they're kind of in the same boat. They were high growth, companies, and then boom, they hit a wall, which leads me to make a point, which is, so I've been investing for 30 plus years. And when I invested 30 years ago, as I should have been doing, is I would take, I would make investments in high growth. And in some cases it worked out. In some cases I lost my entire investment. And, it kind of taught me a few things, and it was the right thing to do 30 years ago. I mean, I was trying to have a great rate of return, which I achieved, and overall just grow my wealth. I didn't need the money 30 years ago. I still don't need the money today. But now that I'm 56, I'm like, okay, I'm not going to dabble in high risk. It's, if I know an industry really well, and I know one company really, really well, and I see that it's misunderstood, the fundamentals don't make any sense. You can't use a fundamental analysis on that. I might invest in that company, but that might be one stock in a portfolio that I have of 30 plus stocks. Okay. That would be the exception, not the rule. 30 years ago, I was like, oh yeah, man, stocks like SolarEdge, I'd be like, this thing's going to recover. Boom, throw a few bucks at it. That's not me now. I'm like, okay, enough of that, man. I want to pick the winners. I'm going to buy more Google. I'm going to buy more Meta. I'm going to see the winners and put money down on that. I do have some small stocks. I think small caps are going to do well going forward, but this one's not the right small cap for me. So thanks for asking about it. Looks like Shadow Guy, down market, fine with you. Nice. Some of your dividends are coming in. You get to reinvest them today. Very nice, man. Dividends are a way of making money while you sleep. You're sleeping, getting a good night's sleep. Meantime, your dividend stocks are out there making money, and then you wake up and go, oh, cool. Looks like I received a nice dividend, and put it back into the market. Or if you need it, spend the money. All right, so we went over SolarEdge. Let's take a look at the stock that's going to be on the stocks contest later today. Got to get my head in the game, see if I can get close on this stock here. So GitLab, through its subsidiaries, develops software for the software development lifecycle in the United States. Correct. Yeah, I remember these guys. All right. Got it. I think these guys had a link to Google at one time. They're in San Francisco. Okay. All right. So it's a $7 billion market cap company. So I'm going to say it's a small cap. 622 million in revenue. They lose a lot of money. Ooh, man, that's a lot of money. Take a look at their financials. Forward PE is really high, 108. Oof. Analysts say, don't look at that. It's discounted by 39%. Okay. Well, I'll be the judge of that. I like the green on the screen for growth. That's really good growth. Now they are small, but they're going from tiny to small, and they continue to grow. When a company is this small, I mean, they can keep doubling in overall size every couple of years. Nobody pays attention because they're small. It's when they start getting into like, okay, now we're 5 billion, now we're 10 billion. And then they have a new set of competitors and it gets harder to grow. But now I think that growth is going to persist. So earnings per share has been negative as expected. It's a growth company. They do provide free cash flow. Now, for young, small companies to produce cash flow, it's rare. Okay. When you're in growth mode like that. So let's take a look at, I'm going to tell you, I'm going to guess at why they have good margins, because software companies do. We looked at Dollar General, remember, and it was 30% gross margins. Revenue is 622. Cost of revenue, 64 million. So their gross profit is 90%. You see the big difference? Dollar General, gross margin, 30%. GitLab, gross margin, 90%. So there's a big difference in desirability. When we look at this little, thing is, I usually like really strong software companies that have a very good position in their micro industry, because software could be many, many different forms and types. I could put them in the green. If it's an older software company, it might straddle both, or maybe in the gray. But software companies tend to often land in the green for me because they're really profitable. They generate free cash flows. If they have a very good software for maybe a new space, like a new set of needs that software really focuses on, that's really good. So let's keep digging on this, man. GitLab. All right. So I'm pretty sure the balance sheet's going to be good. It's $1 billion of cash on the balance sheet, and debt, they owe $37,000. Maybe the CEO has a student loan he hasn't paid back. Just joking. But you can see that net debt is really, they don't have any debt. They can pay off their total debt by scratching a check out, and we're done. So strong balance sheet. Now I'm going to go to the quarterly on the cash flow because I wanted to take a look at it. Operating cash flow is positive. Very good. Okay. And what goes into that cash flow? You have a loss from the income statement, but just a quick tutorial on, these statements we look at. Every company that's publicly traded has to produce an income statement, a balance sheet, a statement of cash flows. Income statements must follow generally accepted accounting principles, GAAP. GAAP requires companies to use accrual accounting. Accrual accounting somewhat distorts cost and cash, because they have to do accruals. They have to do a bunch of things that accountants would understand, and it's really hard to explain very quickly. But I would just tell you that the income statement, Charlie Munger did not like the income statement. He thought that the numbers were too masked, that there's a bunch of BS in them that he doesn't like. And what the cash flow statement does, and the balance sheet tells you how much assets they have, how much liabilities they have, and equity you have. So, we looked at cash versus debt, an asset versus a liability, and you see that they have far more assets. The cash flow statement is meant to undo a lot of that accounting based on generally accepted accounting principles and show you a true reflection of the cash basis of that business. So that's why it's really trusted statement. That's why investors mostly focus on the statement of cash flows. Is it takes the net income and it says, okay, we're going to undo a bunch of this stuff that you have to do for GAAP. Like depreciation, we're going to add it back because depreciation is a non-cash item. You're just depreciating something you already paid for. It's not like you have to pay for it again. You're just depreciating, in their case, probably computers and servers and stuff. And then other amortization for them, it might be that they acquired a piece of technology, because an asset, a physical asset, a car, you depreciate it. An intellectual property right that you bought, you amortize it. Okay. And then they had loss gain on investments, meaning they have a gain on an investment. So that you have to undo it because it's like not a cash event. You didn't sell it. It just went up, but you didn't redeem it. You didn't realize it. Stock-based compensation gets added back. And just a quick note on stock-based compensation. I think it's fine. Some people dislike it. They say, oh, it liquidates company. But I would say that there's some people at this small company that are working 7 days a week, 14 hours a day, trying to make this idea happen. And if you don't give them partial ownership of this company, they're not going to work 7 days a week, 14 hours a day. They're going to be like, well, if I'm just going to be an employee, 5 days a week, 40 hours a week. And without that intense level of effort, some of these companies just won't work. So I want the employees to have stock. I want the employees to be like, man, if GitLab doubles in value, I double my net worth. I'm going to work as hard as I can. So that's my opinion on it. A lot of people would disagree. They're like, no, that's too much stock-based compensation. All right, well, I guess we'll disagree. And then other things so accounts receivable, it just means the balance goes up and down. And we like when accounts receivable goes up because that means we're keeping the cash. We're keeping it so we can use it. And the other things, this one doesn't tell me much. So overall, it's positive. Operating cash flow is 38. Now, they shouldn't have much. See how they don't even list it out. CapEx, there's no capital expense for this business. They don't have to. Actually, they do. This is basically, these are in millions. So this is $700,000. They probably bought servers and stuff. You see how low that is? Remember we saw that utility company? And they had operating cash flow. They had more expenses related to capital expense than they had cash flow from operations. Where software companies and really valuable companies, you have very little CapEx. So I like this. I like this very much. So here is where, with small businesses, I kind of massage the numbers. And I'm going to say that these guys are on a run rate of, what's their trailing 12 months? So CapEx. So their trailing 12 months is 82. So 82, it's high growth. So if I multiply that times 30, I would get to about 2.4 billion. They're at 7.45 billion. Whew. That is kind of a leap. Yeah. What's their revenue? This one here, I mean, it's not like a no-brainer. It's growing at 34%. Yeah, you'd have to really go out there on believing in their growth, that they're going to keep growing and so forth, and put a high valuation to get to this number. So to me, it's a pass. It's just, I'm not even close. I'm getting to like maybe 3.5 billion in value, back of my, top of my head, back of a napkin. Now, what's it going to do after the stock market closes? So right now the market is down. Wow, it's down pretty good, 1%. It might recover. That's why I'm going to wait till like 1 hour before the market closes to make my best estimate. Because for all I know, this stock's going to be up 1%. So if I make my guess now, I'm going to be way off. So I'm going to wait till the market closes. And I'm probably going to guess to the upside, because if there's a big sell-off, usually the markets have a little bit of a bump after they close. They're like, okay, everybody stopped selling. And maybe the options activity props up a stock. So I'll probably go up like, I don't know, 0.5% and guess at that based on the price that I see 1 hour before the market closes. We'll see. But this one here, interesting little company. It's cool to see these high growth companies. But you just got to get way out there on your optimism for the business to make the company valued at this level. They're also in a space where like security is super hot, right? Because CrowdStrike did such a terrible job. If you showed all this and just said, oh, they're in the security space, this stock could be like $30 billion in market cap. Investors would be really excited. But they're really developing. Their software enables the collaboration of the development cycle for software development, project development, IP development, any kind of creative, professional, intellectual property, creative cycles. That's where their software is in. So, all right, we'll see where that stock price lands after the market close. NVIDIA takes the market down with it. Wow. What's going on with NVIDIA? Oh, dude. I need another cup of coffee. I think I'm seeing NVIDIA down 5%. Let me make sure my mind is not playing tricks on me. Wow. Okay. Our friends here at NVIDIA. See, this doesn't really tell us the story. So you guys that follow me know that I am shorting NVIDIA. I started shorting NVIDIA at the very end of May. I've held the position open. I average a dollar cost average my investments. I am not smart enough, lucky enough to pick bottoms and tops, but I know when a stock is most of the time it's discounted. And there's a really good time to buy it in a zone. And then most of the time I'm correct that the stock will move up. So I'm correct on the direction. Okay. I bought all these shares. I bought them over the course of time, and I bought them in a zone where I felt it was discounted and it rises. In the case of NVIDIA, I'm like, okay, this stock's overpriced by a substantial amount. So I started buying at key points. Like today, I wouldn't short any more shares because the stock's down. So my short position is actually positive today if their stock's down 5%. Now, these guys, I just did a video on my channel and I put it on stocks during the marathon stream that I did for 3 days. And you guys can see all my notes there, I think. But this stock's gone parabolic. The next 2 weeks, maybe 3 on NVIDIA is going to set the table for where's this stock going. If several big investors leave NVIDIA, this stock's going to fall. It's the retail investor, it's fun. Retail investors create a lot of noise, a lot of chatter. I'm a retail investor, so I'm not, saying, oh, retail investors are bad. No, I'm a retail investor. I invest my money. I put it into stocks. But when you look at institutional money, and like Warren Buffett is an example, he owns, is it $80 billion of Apple? Billion. That's a pretty good position. My biggest position is Meta. I own like $220,000 of Meta. I'm like, they don't even notice me. And that's my biggest position. Now, NVIDIA, if a few of the big players that own billions of NVIDIA leave the room, it's going to cause, like today, you're probably seeing some stop loss orders triggering. When big investors stop loss action happens, and other institutional investors will leave. These institutional investors, right? It's a community. Like we're a community. You're asking me, what's my opinion on a stock? So we collaborate and I share my opinion. They do the same thing, except they're in a really high net worth, massive investor community. It's like if we're coming up on the NFL. So I got NFL in the brain. NFL players have a community. They talk about it, hey, how do you tell me about your off-season kind of training regimen? Tell me about your nutrition plan. And they collaborate. Institutional investors collaborate. They might say, you know what? I've been in NVIDIA for a couple of years. I made a lot of money. I'm getting out. The future is unknown. There's a couple risk factors. Blackwell, will the demand for AI really persist? I don't think so. And if once a few leave and they tell their buddies in that network and a bunch of big investors leave, that's where the big drops happen, is on the institutional side, big hedge funds. And I'm hearing more stories online where the story a year ago was AI is going to do everything, man. And literally people were coming out with medical use cases. And I happen to know pharmaceutical quite well. And it's like, there's no way you can use a technology without having FDA approval. There's no way doctors are going to use the technology without it being part of their curriculum in med school or it being continuing education for them. The fastest timeline that I see for AI being used in any healthcare capacity is 15 years. That's fast track, because for good reason, the FDA doesn't go, oh, that seems like a good idea. Let's try it on humans. No, they're like, we want you to study it for 3 years. We want you to study it for 5 years, and then come back with data. And then I want you to do animal testing. I want you to do this. And then I want to do placebo testing and all kinds of stuff. 10 years after starting, you might have a chance to seek FDA approval. Then the FDA process is a multi-year process. So a year ago, I was hearing stories on AI like, are you kidding me? Robotaxi is another great example. If you guys follow Waymo, which is a Google Alphabet asset, it's a really interesting technology. It's phenomenal. They've been working on it for 15 years. After 15 years, they operate self-driving cars, robotaxis in 3 cities. 15 years, 3 cities. They're spending a boatload of capital on that business and very little revenue. And that's one of the biggest best, brightest, smartest companies on earth. It took them 15 years. So everybody with AI, it's like, it's not going to happen overnight. And investments, investors are not patient. If you have a couple of quarters of no growth, your stock's going to get hammered, and we'll see what happens here. One thing that I wanted to just highlight on NVIDIA, that so part of my background, just so that you know, I graduated in accounting, and I was either going to be an engineer or I was going to be in finance. And I thought, well, I'm going finance, and I loved software, and I ended up transitioning from my finance career, accounting career, to software. Now, one of the things I loved doing was modeling, and I used to model forecasts for revenue. And I was with a pharmaceutical company. I used to model all the production lines. I was with an oil company. We used to model the exploration of resources and getting them to market, and on and on. I don't want to bore you too much with my accounting career, but I put together this forecast, and this forecast is outside my free cash flow and so forth. But when it comes to this, these are numbers that NVIDIA has provided. And I put this in my, I think I put it in my video. So the section that I'm showing you, and it's a little bit of an eye chart. Let me see if I can make it a little bigger. So here, this is the quarters, right? And the quarter that was just announced is right here. Okay. This is NVIDIA speaking. Hey, everybody, world. If you compare this quarter versus a year ago, we grew 122%. Excellent. Sequentially, which means when you compare this number to the previous quarter, we grew 15%. That's still very good. But you're NVIDIA. You have to be great times 10, because that's your stock price. It's not, if you did okay, it's like, no. You have to do awesome times 20. This sequential number is what I'm looking at, because this is a number that NVIDIA guided. We're going to do $32.5 billion of revenue in Q3. The growth, if you compare this number to the previous year, is going to be 79%. So you see that there's a big drop between 122 and 79. Sequentially, you dropped your sequential growth by 50% roughly. And from there, I then take that type of sequential growth and I projected out their revenue. Okay. And I think that they will stop growing in 2025. And when that hits the street in a quarter or two, then we're really going to see this stock go from, it was $3 trillion valuation, maybe get to 1 billion. The stock market at times is irrational. It's irrational going up and it's irrational going down. I got Meta in the brain, guys. I am sorry. I don't have enough coffee. It's West Coast, California. But this is the example I want to show. The stock market said Meta is terrible. They're so bad. They're horrible. We're going to discount it by 76%. This is when a company has some trouble around the metaverse. They still have their main social business, social apps business, just firing on all 8 cylinders. Dominant. Almost 4 billion people are a monthly active user on a Meta platform. I don't care about that. These guys are just terrible. The whole metaverse thing didn't work. 76%. Selling it off 76%. So if that can happen to Meta, and I can show you company after company where this is the case, what's going to happen to NVIDIA when they stop growing at the leaps that the market expects? That's my story on NVIDIA. We'll see where it goes. Thanks for asking. Yeah, thanks, Noam. Looks like you got to go. Thanks for joining. Thanks for getting me riled up around NVIDIA, man. Good stuff. All right, so we covered NVIDIA. Didn't plan on covering that. We covered Dollar General. And it looks like, I've caught up on the, one more. So somebody on Discord brought this stock up. Actually brought it up. I'm going to call it this morning for me. They may have brought it up in the middle of the night. Or I think this person, he's actually in Europe, or North Africa. So I think it was his daytime. Well, Monday is down 4.41%. Did they announce August 12th? Oh, how come they're down so much? What's the market doing? Let's see here. Yeah, the market's selling off pretty good. Now, I did a couple of videos right now. September is a month that usually brings good pullbacks and corrections. It's not abnormal. I looked at last year, bad. Year before, bad. Year before, the month of September. In 2023, sold off. 2022, sold off. 2021, sold off. 2020, sold off. It's like, okay, market tends to sell off in September. So it's selling off, first day of trading in September. So heading back to Monday, this is a $12 billion company. This company is a software company, and company provides work, operating system, a cloud-based visual work operating system. It consists of modular building blocks used to assemble and create software applications, work management tools. Its products include Monday Work Management that manages workflows, projects, portfolios, team collaboration, productivity. Okay. So they do like, project management software, I guess. Okay. All right. And where are they headquartered? Israel. Cool. So they're a $12 billion market cap company. They have revenue and they are profitable. PE is really high, 316. Forward PE is 89. Strong buy, but it's only discounted by 10%. Good growth rate, very good growth. They are small. Back to that small company. I think we saw, was it GitLab, had really good growth. And they're small. They could probably continue to grow. Now, this is somewhat of a crowded space. The whole project management area, there's quite a number of competitors that I know of, and they have very good cash flow. Look at that. So 263 of free cash. Very good. That looks good. Balance sheet, they've got 1.29 billion of cash and 56 million of debt. So really no debt. That looks good. So cash flow was 263. So if I multiply that times 30 or 40, so 30 would get me to like 7.8, and 4 would get me to like 10. Yeah, this one's hard for me to value. They're just not quite there. I don't know if I can grow their cash flow fast enough to just substantiate the stock price, let alone show a discount. Their cash flow is growing really fast, but small companies like these can really surprise you. It grew to 263, and then a year or two later, it's down to negative 50. It's just really, young companies can really surprise you to the downside, and that's risk. I usually discount companies like these with a higher discount rate to have a greater return because I'm taking a higher risk. So this one here, I'm going to pass on. I just don't see enough evidence to like it. FYI, I think the software industry within technology is very good right now. I think prices are reasonable. I've been buying into Adobe. I've been buying into DocuSign. There's some really good software companies that were kind of left behind or ignored because everybody was investing in AI. But now that we're seeing like maybe the AI trade kind of unravel, maybe it's a pretty good idea to take a look at software companies. I'm doing that, and I'm going to go for it. All right. So looks like I'm going to try to land the plane and finish this live stream. But before I do that, this is one stock that I aim to sell. It's up. Okay, cool. I'm going to sell my position in CVS. I've just been waiting too long for this stock to do something. It is not a pretty picture. And there's a lot of value here. I could definitely make that argument. But there's a couple things going on. Is first, I expect that September usually has strong pullbacks. I want more cash. 2, I have really nice healthcare investments. So when I look at my healthcare stocks, and I apologize for clearing my voice, everyone. It's early here on the West Coast. Man, I love healthcare right now. Love it. But I've got plenty of healthcare. So let me trim back and kind of take the weak one out of the lot and keep putting money into the rest of them. So I'm going to be selling that today And I communicated that on a video. I actually recorded the video, and it's going to release at 11. So FYI, if you watch that video, you're gonna you're gonna hear me talk about how I'm selling CVS today. So I'm gonna be selling this stock today. I'm not recommending you buy, hold, or sell CVS. I'm just an individual investor sharing what I'm doing, but it's not financial advice. As always, I never provide financial advice. I'm just sharing my opinion. All right, everybody. So let's keep our fingers crossed that this is not going to be a week-long trend of stock prices selling off this fast. This would not be fun to watch values of stocks go down. I'm curious to see where are we at with crypto. Crypto's still rocking. All right, go crypto. As mentioned, when we got started, my stocks did well in August. And, I like where, stocks last month had me a little concerned because the first 3 days of trading, and I don't think I'm going to be able to show that very well using this, but like the first couple of days of trading in August were really bad. And like literally I was like, holy smokes, man, my portfolio is kind of falling off a cliff. And then it recovered nicely, as you can see that here. Meanwhile, my crypto really did terrible. So I had really good gains on the stock side, and my cryptos really did poorly. Now, keep in mind, my BTC is doing great. Got no problem with BTC. Okay, so I'm not going to complain of 124 return on my BTC. I've been a hodler of BTC and Ethereum starting in 2018, and I'm good. I'm good with my coins. It just was a really strong pullback in August, and I was like, what the heck? That kind of took my gains, and it took a lot of the air out of my balloon when it came to feeling good about my stocks. I'm like, man, I feel good about my stocks, but my crypto, holy smokes, that was a pretty good pullback. And I'm okay holding it. I mean, this return speaks for itself. I'm going to be all right. And we'll live to fight another day. All right, everybody. So I really appreciate everybody joining the live stream. I'll be back tomorrow, same time on stocks. You can check me out. In the meantime, visit my channel if you want more information on my YouTube channel. If you want more stocks and so forth, be glad to interact with you on Discord. There's my Discord channel. If you watch this live stream, it's gonna end, and then I'm gonna open it up again, and in there you'll see that I provide all the different ways for you to engage with the community that I've started. It'd be great for you to participate in it. So everybody, good luck this week. I think we're gonna need it, and thank you very much for tuning in. Enjoy your Tuesday.